Everyone calls selling puts free money. It's not free, and there's one part that quietly catches almost every beginner. In the next few minutes, I'll show you exactly how a cash-secured put works, the real numbers behind it, and the one rule that keeps you out of trouble. I'm Vega. Let's make it make sense. Start with the plain English version. When you sell a put, you're making a promise. You agree to buy 100 shares of a stock at a set price, the strike, if the other side decides to sell them to you. In exchange for that promise, you get paid. Let's break down the pieces. First, the premium. The moment you sell the put, you collect cash up front, and you keep it no matter what happens next. That's your income. Second, the word cash secured. It just means you're holding enough cash to actually buy those 100 shares if you have to. That's the strike price times 100. Setting that cash aside is what makes this the safe version. The reckless version, selling a put without that cash, is called a naked put, and that's a different, riskier animal. So why would anyone do this? Simple. You get paid to wait to buy a stock you already like, potentially at a discount to today's price. If it never drops to your strike, you just keep the premium and do it again. Let's put real numbers on it. Here's Apple, trading around $333.74. I'll sell the $332.50 put 32 days out. The tool shows the premium, $12.17 a share. One contract is 100 shares, so that's $1,217 in my pocket right now. That $1,217 is my maximum profit. See the flat top of this line? Above the strike, that's all I make, and I keep it. Now the break-even. It's the strike minus the premium, $332.50 minus $12.17, so $320.33. As long as Apple is above $320.33 at expiration, I'm in the green. That's about 4% of cushion below today's price. And the number nobody talks about, what I'm actually committing. I've promised to buy 100 shares at $332.50. That's $33,250 of cash set aside. Worst case, Apple goes to zero, and I still have to buy at $332.50, cushioned only by the $1,217 I collected. So the theoretical max loss is $32,033. Unlikely, but that's the real size of this position. This isn't a $1,200 trade. It's a $33,000 trade that pays $1,200. One more thing worth noticing. The tool flags this premium as exceptional, 43% annualized. Treat that as a signal, not a prize. A rich premium means the market is expecting a big move, and notice this strike sits almost exactly at today's price. A more conservative cash-secured put would sit further below the stock and collect less. You're paid more here precisely because assignment is more likely. We'll come back to why that matters. One quick note before we go on, these are the tool's theoretical numbers. Your broker's quote will differ a little, so always check the real chain before you trade. So you've sold the put. From here, only two things can happen, and you need to be happy with both before you ever click sell. Outcome 1. Apple stays above $332.50 at expiration. The put expires worthless, the buyer walks away, and you simply keep the $1,217. No shares, no obligation. You can turn around and sell another put and do it all again. This is the outcome you're rooting for. Outcome 2. Apple drops below $332.50. Now you're assigned. You buy the 100 shares at $332.50 like you promised. But remember, you were paid $12.17 to make that promise. So your effective cost is $320.33 a share, not $332.50. You wanted this stock anyway, and now you own it about 4% below today's price. And here's the part that scares beginners off unnecessarily. Getting assigned does not mean you lost. You're still ahead anywhere above your break-even of $320.33. If Apple lands at, say, $325, you own the shares and you're profitable. You only take a real loss below $320.33. That's the genuine risk. If Apple keeps falling well below your break-even, you own it, and it's worth less than you paid. Here's where beginners get burned. 4 things to respect. 1. Only sell puts on stocks you'd be genuinely happy to own. Because you might have to. If you wouldn't want the shares at the strike, don't sell the put. Full stop. 2. Your cash is tied up. That $33,250 is locked as collateral the whole time. It's safe, but it's not doing anything else, and that's a real opportunity cost. 3. If the stock craters, you're forced to buy high and sit on a loss. The premium is a small cushion, not a parachute. 4. Watch earnings and high volatility. Remember that exceptional premium 43% annualized the tool flagged earlier? That's what this means. A fat premium is fat for a reason. The market is pricing in a big potential move. Getting paid more almost always means you're taking on more risk, not less. Bottom line, a cash-secured put is neutral to bullish income, a way to get paid to buy stocks you like. It is not a hedge, and it's definitely not a can't-lose trade. Quick recap. A cash-secured put gets you paid to potentially buy a stock you like at a discount. Know your break-even and your max risk before you enter. And only ever do it on stocks you'd be happy to own. Want to see this with your own numbers? Build it yourself on Option Profit Sim, the tool I use today, and grab the free 12-page options cheat sheet. Both are linked right below. I'm Vega. I'll see you in the next one.